Hello. I want to talk to you today about interest rates. Most of the time when people mention interest rates, they think of the Fed. When is the Fed going to lower rates, or when are they going to raise rates? But there's a myth there. The Fed only controls short-term interest rates, not mortgage rates. So I want to talk about how long-term mortgage rates are set. They're set by the investors who lend money to Fannie Mae, Freddie Mac, Wall Street hedge funds that then go ahead and purchase the mortgages that your lenders have made. So how do they set interest rates? And the best way to do this is with a simple example. Let's say that tonight I want to go out and have a steak dinner, and it's going to cost about $100. But my friend Dan asks if he can borrow $100. And he promises to pay me 5% interest and pay me back in a year. So a year from now, he'll pay me $105. I think that's a good deal. I can make $5 plus still have my steak dinner. I just have to wait for it. The problem is a year from now, if the steak dinner costs $105, I've made nothing, and all I've done is delayed having my steak dinner. So long-term investors look at future projected inflation and know that they have to earn more interest on their money than the inflation rate. So inflation tends to be the long-term driver of long-term interest rates. So most people track inflation by looking at the consumer price index. The problem with the consumer price index is that that's a backward-looking metric. In other words, it tells us what inflation has been like over the past year. Investors don't care what it was over the past year. They care about what it's going to be over the next year or the next 10 years. So they look forward, and what they do is they look at forward-looking economic reports to estimate how much they think interest rates or how much they think inflation is going to be over the course that their money is going to be out. So this is how inflation affects interest rates. The Fed raises borrowing rates in order to slow down the economy. So to bring long-term interest rates down, we have to bring inflation down by slowing down the economy by bringing short-term interest rates up. So remember that because we're going to talk about it. So what influences inflation? Well, production costs. When it costs more to produce goods and services, they naturally have to raise prices. What are the major components that go into the cost of producing anything? One is obviously wages. You've got to pay people to build the things, to move the things, to ship the things. You have to pay a lot of people to get the things to market. Another is energy. Now, have gas prices gone up? Well, that's an interesting thing. We're going to take a look at this graph over here. In May of 2020, we all know what happened in February of 2020 as the pandemic started. In May of 2020, the price of a barrel of oil dropped precipitously to only $19.78 a barrel. So what happened? Well, people had to, first of all, there were a lot of layoffs, and then people were told to work from home. So people stopped driving. Demand for gasoline dropped, and suddenly the price of oil was quite cheap, under $20. Now, by December of 2020, when people started coming back to work and started driving again, we saw the price of a barrel of oil go to $48.52 by the end of the year. It's only 7 months later, more than double. But what happened in 2021? Now people are really getting back to work. More people are driving. Suddenly, by the end of 2021, the price of oil was at $75.21. Then in 2022, February of 2022, what happened? Russia invades Ukraine. Immediately, the world's oil supply was constricted. What did we see? By February of 22, the price of oil hit $91. And by June, it peaked at $120, 5 times as high as it was when the pandemic began. So a barrel of oil at that point was 5 times as much as it was in June of 2022. And that happened to coincide with peak inflation, which was at about 9%. So I think you can see that the price of oil has a great deal to do with how inflation's going. And then finally, the third component of the cost of getting things in is materials. What happened during the pandemic? during the pandemic, supply chains were severely constricted. And when they were severely constricted, manufacturers couldn't get the materials they needed to produce goods and services. So therefore, the cost of production went up. They had to raise prices. What else influences inflation? So increasing demand tends to push prices up. In other words, when more people want things, they start competing for them and the prices of them naturally go up. Demand has really two components to it. One is the desire for the product or service. So as an example, what happened during the pandemic? The demand for televisions jumped. Why? Well, people were stuck at home. They wanted new televisions. They went and got their big screens. So suddenly the price of big screens went way up, and it was also harder to get those materials anyway and get them from overseas. So the price went way up. We saw big inflation at that point in time. The other thing that impacts the demand for goods and services, the ability to pay for it of your typical consumer. And that there's three components to that ability to pay. One is cash on hand. In other words, the more cash you have, the more likely you are to spend it freely on things. And when cash is constricted, you're less likely. So if you recall, during the pandemic, in the Trump administration, they passed the Payroll Protection Act and gave billions of dollars to small businesses and medium-sized businesses alike. Basically, they handed out free money that the businesses, for the most part, did not even have to pay back. Then, after Biden got into office, they passed the American Rescue Plan. What happened? They gave billions of dollars to every average, everyday American, $1,400 plus a little bit more in many cases. So what happens is you're flushing the economy with cash. People have cash that was unexpected, that they didn't work for. What did they do with that? They went out and spent it. And when they spent it, they increased the demand. So what happened? Prices went up. We had inflation. And finally, the third component of ability to pay is credit, is access to credit. And what has happened since then? Well, credit card lenders have gotten a little bit more liberal, but more importantly, Americans have become much more comfortable with carrying credit card debt. Household credit card debt has hit new records in 2024, and it seems to only be going up. So as people become more comfortable with carrying credit card debt from month to month, what we're doing is we're seeing them more comfortable with spending money, even if they don't have the cash or the income. So how do we reduce demand for goods and services? To do so, we have to reduce the cash supply and income and constrict debt. The higher unemployment, lower wages, and higher interest rates are the goals that the Fed targets in order to accomplish that. So hold on to that thought for a second. What will it take to bring inflation down then? Stable wages, which we don't have yet, weaker demand for goods and services. So energy and material costs are stable. They have stabilized. Energy costs now, the price of a barrel of oil is back down into the $70, $80 range. But wages are still under pressure. The economic reports in January showed that wages rose 4.1 to 4.5% over the previous 12-month period. Unemployment claims are remaining steady. The Fed is hoping to push unemployment claims up, and we've heard a lot about layoffs, but the total number of unemployment claims across the country has remained really very, very steady for the last 9 or 10 months. New hires increased unexpectedly in January of 2024. New hires shows how many new job openings have been filled. Suddenly, it was a very surprising report. Suddenly we have more people entering new jobs than before. And unemployment rate remains at an historic low at 3.7%. So, and finally, job openings are still exceeding the available workforce. What that means is there are more jobs available than there are people to fulfill the jobs. What happens then? The employers looking to bring workers in have to bid up. They have to increase the wages to attract workers to go work for them. As of December of 2023, the last report, there was 9,026,000 job openings in the U.S. but there was only 6,500 available workers. What needs to change? Long-term interest rates will decline when the expectation of future inflation declines. So how do we make that happen? We've been talking about this. Reduce job openings. So increase short-term interest rates, reduce the demand for goods and services, and that forces companies to either lay off or delay hiring. So the Fed is actually watching job openings, trying to get that number down. Decrease wages. So if we reduce the job openings, that will reduce pressure, upward pressure on wages. And we need to increase the available workforce. So how do we do that? First of all, increase unemployment. So as more layoffs occur, the number of unemployed grows. So remember that 3.7% figure, it's been very stubborn. But if they can increase the unemployment rate, that will take pressure off of wages. And they can increase immigration. Not very popular right now, especially in an election year. But more available immigrant workers does tend to help fill low-wage jobs. And they can increase workforce participation. So here's something interesting. The higher wages go, the more motivated people are to get back into the workforce if they've been sitting it out, staying at home to take care of children or something. So there's a sort of a self-leveling mechanism there, but that's really what needs to happen is we need more people to come back into the workforce. So what are investors looking for before they're going to be willing to lower those short-term rates? Steady energy costs, which we have. Steady supply chain, a stable supply chain, which we have, and stable wages, which is only going to happen when we have increased unemployment and more available workers. Put simply, they're going to repeat the concept from the beginning. The Fed raises short-term interest rates to slow down the economy, to decrease demands for goods and services, and to stabilize manufacturing costs. When that happens, that's when you're going to see long-term mortgage rates begin to fall. I don't see that happening for at least a few more months.